$100 in the S&P 500 since 2024 is worth about $149 today. The same $100 in Pokémon cards? 247. Cardboard beat Wall Street by 3-1. On the gain, not the total. But that number is not why you should care. The interesting part is a single decimal almost nobody has looked at. First, honesty, or this whole channel is worthless. That plus 147% is 2.4 years, a short window in a hot collectibles cycle, measured only on the cards liquid enough to track. That's recency and survivorship stacked together. If the pitch is sell your index fund and buy Charizards, the math does not support it. So forget the race. Here's what actually matters. We pulled 2.4 years of daily prices, the S&P from public market data, a basket of Pokémon cards from our own index, and measured how much they move together. On a scale where 1 is lockstep and 0 is independent, the answer is 0.04. Essentially, nothing. When the stock market sneezes, Pokémon doesn't catch the cold. It isn't a bet on the economy. It marches to set releases, nostalgia, and hype, not to interest rates. Here's why a boring decimal is the whole story. In investing, mixing two things that don't move together can lower the ups and downs of the whole pile without killing the return. The closest thing to a free lunch there is. A slice of something uncorrelated is a shock absorber. When stocks are down, it isn't necessarily, so your total swings shrink. That is the only legitimate reason a serious portfolio touches an asset like this. Not because it goes up more, but because it goes up differently. Now the part the hype reels skip. Uncorrelated does not mean safe. This asset pays no dividends. It just sits in a binder. It is brutally illiquid. The price you see is a listing, not a guarantee you can sell there. Try to exit a four-figure card fast, and the buyer may not exist. An individual card still crashed 52 to 74%. We've shown the pumps that round-tripped and the chase cards that halved. Low correlation, high fragility. That combination has a name, a sleeve, not a swap. So how would a grown-up actually hold this? As a small satellite, a slice on the edge of a portfolio, never the core. You size it like the illiquid, high-variance thing it is, money you won't need soon, spread across cards that actually trade, and you judge it by whether it diversifies, not by whether it prints. Treat a card you can't sell as worth zero until proven otherwise. So, is Pokémon a hedge? It's not a better stock. It's a different asset, genuinely uncorrelated, which is rare and useful, wrapped around genuine illiquidity, which is dangerous. A diversifier you can hold, not a 401k you can replace. Comment hedge and we'll show you how to check a card's liquidity before you ever call it an investment. And if you think a single card is risky, wait until you see the math on ripping sealed packs. The vast majority of sets lose money before you open them. That's next.